This webinar was recorded live February 19th. Remember, trading is risky. Please do not trade with funds you cannot afford to lose. Talk to your broker and read the risk disclosure before trading. All right, everyone. Let's do a quick sound check. I think everyone can hear me and could see my chart as well. My name is John Paul, founder of daytrade2win.com. What I'm showing you here on my chart is the Trade Scalper software. The top chart is the E-mini S&P, which many traders trade. The bottom chart is the crude oil. The reason why I'm showing you these two markets here with the software is because they do very well with the Trade Scalper. So I want to give you an example of what you can expect every day on the price action software that you're seeing here, the Trade Scalper. I also want to teach you a little bit about trailing stops, how a lot of traders use trailing stops may not be the way to go, the profits and the stops, as well what we can expect out of these trades. Again, if you have any questions, feel free to post them in the Q&A box there. I'm assuming everybody could see the Q&A box, but if you're not able to ask your questions there, please email support@daytrade2win.com, and that way I can help you further, or somebody can help you further. When you look at scalping the markets, typically you're looking at a small stop and a small target, and they have to be relative to the markets that you're trading. Many times traders want to have these very small stops with very large targets. Sometimes that's possible. But in the normal aspect of trading, the market doesn't move straight up or straight down. It does fluctuate. So when you have the market fluctuating up and down, you can't expect it always to go straight into your target. It flip-flops. So for example, if you see this trade here long on the crude oil here earlier, right here, if you placed a very tight stop, the market went down a little bit before it came up. So you have to have a stop that's large enough to keep you in the trade. The same thing if I look here at, well, this short here went straight down and this long here went straight up. So in this example, this is very good. Another thing that you're looking at with, here's another short example right here. Another thing when you think about trading right as the market opens, I typically tell the people that I work with not to jump in right as the bell rings or the market opens, whatever market you're looking at. The reason is because typically there's a higher volatility as everybody buys and sells entering into the market. So it's not a very good idea to just jump in right as the bell rings or as the market opens and get caught up in the chaos. Sometimes the market goes up within the first minute or two and then down very hard and very strong. So these are things that you should be aware of. In addition, when I look at scalping, I like to take personally about 3 to 4 ticks on every trade. You can absolutely trail a stop. There's nothing wrong with that. But your first target should be small enough that you make that first tier target before beginning to trail a stop. So your first course of action is to try for 3 or 4 ticks. A lot of traders trade multiple lots, multiple contracts, so they're all out. If they are trading just one contract, again, you can take your profit and run. If you want to trail a stop, you can do that as well. I'm going to cover trailing stops here in this class as well. Let me just go here into the future here. All right. So as we see here, these orders, I'm going to be explaining to you a few things. When it comes to trailing stops, there's a few ways that you could do it. Typically, a lot of traders, if let's say you went short on the crude oil right here, as soon as the market starts to go in your favor, they immediately tighten up their stop and they don't want to lose any money, okay? And I guess that makes sense, right? Nobody wants to lose money. But I think that you have to treat this a little bit differently because if the market starts going in your favor here, starts going down, and you want it to continue to go down or continue to go up, you have to allow for the market to do this type of thing before it goes down. So we have to think about giving the trailing stop enough room or breathing room in order for it to go in our favor or make the move more valuable, let's say. When you have higher volatility, the markets typically trend more. When the market is slow, especially if you notice the holiday, President's Day on Monday, the market was very slow. So it's not really an opportune time to trail a stop or even maybe to trade. You should stay out of the market during those times. But I've noticed that when the market is more volatile, you should expect more of a trend to occur. If the market is slow or during slower times, let's say after hours, the Globex, you don't really expect a trend. You expect more chop and whipsaw. So these are the things to look at when you're looking at price action, understanding price action. Trade when the market is better or right. You don't have to trade 100 times a day. You just have to trade a few times a day, be consistent, and finish. You don't have to stare at this all day long. So when you look at a trailing stop, let's say that the entry here, we'll take a look here at the E-mini S&P for a moment. Let's say the entry is 33.80 right here. It's a long trade at 33.80 as an example. When the market starts to go up in your favor, what you want to do is have the ability to lock in or take some type of profit at a predetermined target. So we're talking about 3 to 4 ticks. We'll make it easy, 4 ticks. As soon as the market goes from 33.80 to 33.81, your first target, 4 ticks or 1 point, this would be your opportunity to lock in your target. Now, I've only mentioned at the moment one contract, but really to do this right, when it comes to trailing stops, you should use multiples of 2, 2, 4, 6, 8. So what I want to do when I look at thinking about a trailing stop here, I want to take 2 contracts, lots of 2, when I enter at 33.80, 2 contracts. Once the market goes in your favor, remember, we're just taking 1 point of target, take half of your position off. So half of your position comes off the table. Now you're left with the runner. Now your stop initially, let's say your stop is down here somewhere, let's say 33.78 as a stop. You started off with 2 contracts on your stop here. What you're going to do, let me just change that color. What you're going to do is update first this to 1, right? Because we took profit on half of our position or 1 contract at 33.81. So you're going to change that to 1. So just 1 contract now. And you're going to move that stop equal to the profit you made, but on the opposite side. What we're trying to achieve here is a $0 trade where you don't lose any money, but you have enough breathing room to let this fluctuate up and down. So if you made 1 point here on the first target, you're going to move your stop on the remainder half of your position 1 point in the opposite direction. So you have this as the area to let the market not only continue higher, but also if it has to come down before it comes up, you're letting this breathe. A lot of traders place their stop immediately at where they entered or really tight. I think that's a mistake. You're going to get stopped out because of the random fluctuations up and down. So what I want to do is as soon as that one target, the first target, whatever it happens to be, it could be 1 point, 2 points. It could be any method that you currently trade. It could be the Atlas line. It could be the ATO. Whatever you currently trade, the way that you would trail a stop is as soon as that first target is hit, update your runner, the stop on that runner equal to the profit you made. It's true that you could lose the profit that you made by the market coming back down. Absolutely. But as this here gives me enough breathing room to see it come up. And I'm going to try to see if I can identify some trailing stop opportunities as we see the market here trade live this morning, Wednesday, February 19th. All right, Adrian, Alpha, Dave, Douglas, Ed, Ernie, Galen, Jason, Jimmy, Kenneth, Mike, Naveen, Nolan, Rob, Ron, S, Sally, Scott, Tom, everybody. Does anyone have any questions so far? I'm assuming everybody could see my questions and answer box. If you can't, please email me at support@daytradetowin.com. Okay, so far so good. All right, so we're looking for opportunities here on the scalper. As of yet, the only opportunities were here pre-market, here long, here short, short, and long. Let me show you something else that happened yesterday. Here, this is the Atlas line. This is yesterday. So yesterday on the Atlas line, if you'd like to see an example of what happened yesterday, as soon as the market opened, we had a short trade here at 33.7250. It's this candle right here. And from this point on, these additional P's and these S's are called pullback and strength trades, and the market continued lower. At the same thing, the market gave you additional pullback and strength trades to tell you to go short. The market continued lower. The same thing here to continue lower. And there's no other trades here until we start getting longs. So we have a long trade, we have a short trade, here a little bit of flip-flop towards the end of the day. But the main signals occur, I think the best opportunity to trade within the first 2 to 3 hours of the day. You have it right here. So this is yesterday on the Atlas line. So as I go back here to the scalping method, does anyone have any questions on the trailing stop situation that I explained here, where you're starting off with multiples of 2, and as the market starts to go up or down, let's say, but in your favor, you lock in profit during your first target, and once that first target is hit, you bring up your stop on your runner equal to the profit you made. So this becomes essentially a $0 trade. If everything goes wrong and the market goes against you, you lose $0. I mean, you do have to pay for commission, and there could be a tick of slippage, but that's not the end of the world. What we're trying to avoid is those big losses that occur. That's the first thing. Now, opportune times to trade. I mentioned early in the morning, which would be the start of the session. Those are always the best times to trade. When you first start trading any method, you should start off practicing and then starting with one contract. And the goal psychologically, when you start trading with one contract, is not really to make a ton of money or lose a ton of money. It's to gain confidence that you can consistently make the $100 or $200 depending on your profit target. Or if you lose $100, can you make that $100 back as you trade? So the goal when you start trading any method is not to jump in with 10 contracts or 20 contracts or with big money. It's really to get a handle on how to trade consistently, and then you increase your lots, because there's a big difference when you trade one contract in comparison to when you trade 5 or 6, because every time the market ticks up or ticks down in your favor or against you, that's going to affect you as a trader psychologically. So start off with one. When you feel comfortable that you can do one contract, then you go to 2. When you feel that you're ready to go to 3, then you go to 3. It may take you a week, it take you a month, let's say, to get comfortable to increase your lot size, but you start off understanding that you can do it with one contract before you increase your lot size. Something else I want to mention is that the conditions of the market, when you talk about price action, is relative. The slower the market is, the smaller the target, and the longer it takes for anything to occur. So every day is a little different, but I'll give you a little tip here that days occur in cycles. It's very common to see one day that is very slow turn into 2 or 3 or 4 days in a row of very slow activity. And the same is true when you have a volatile situation. One day it could be because of news or something else that happens, a news report, but you do have cycles of 3 or 4 days in a row of very volatile activity. Now you take that volatility and you can say I can expect a trend during that volatility. So really what that says or that relates to is that you can have multiple days in a row of a trend and multiple days in a row of whipsaw or chop. So if I look here at a daily chart, and let me just bring up another chart here. If I look at a daily chart, you can see this activity where the market is giving you very slow days. Just bring this up here, back to back as a cycle, and then very large range days or trends in a cycle. So let me just remove here this and go to a daily chart. At the same time here. So you can see that we have this day, back to back that are trends. Even this day and this day that are back to back as trends. Both of these days are trending days, but I want you to take out of the equation the direction. If the market is trending to the short side, it doesn't mean that the next day is going to be another short trending day. It could be a long trade to the upside. So back-to-back days of trends without the direction. The direction doesn't matter. So you have this here being a really strong trending down day, followed by a very strong here up day and a really strong up day here as well. The same thing with this here. Hopefully everyone can see that chat box there. All right, so you have here trending day down, trending day down, trending day up, but they're all trending days. So it's a grouping of these days. And again, if you take a look at this here is a grouping of days that are flip-flop or that they're not necessarily something that we would like to see because there's a lot of up and down, but these days also occur in a cycle. So small range days occur in cycles, long range days occur in a cycle. Also, I just saw here a long on the E-mini S&P 3384.50. So this is a long trade live E-mini S&P 3384.50. Now, when you enter into the market have touched, limit order, you can go in right at market, that's fine. But you do have to be careful not to chase this. So if you are going into this market, let's say at 33.86 up here, remember the signal to go long is 33.84.50 here, right? So if you pay attention and you start looking, you realize the signal occurred, and now you're entering a point or two above where you're supposed to, that's not a very good thing. You have to be very careful not to position yourself chasing the market, okay? Even if you try to get a better price, sometimes, as an example, when you have a signal here to go long, the market doesn't immediately go long. It goes down a little bit by a tick or two. If you realize that you're able to get a better price, 33.84 for example, or 33.84 and a quarter, that's great. If you're able to get a better price, the better positioned you are. Okay, so 33.84.50 is this long trade. Remember, 1 point targets is typical. If the market is slow, 3 ticks. I try to use market if touched. Market if touched orders, by the way, here, just let me show you here. Market if touched order works exactly the same way as a limit order. So there's really no difference when it comes to limit orders or market if touched orders as a matter of how you place the trade. So for example, this here would be a limit. This here would be a market if touched. So these are the same placement below where the market is trading as a buyer. This here indicates that you want to get this price or better or nothing. This price here, let me just put this up here, indicates that you are going to want this price as soon as it touches it, get me in at market. So the drawback with a market if touched is that you have to expect some type of oh, the market took off. Cancel that. You have to expect some type of slippage, maybe in your favor if you're lucky, but typically one tick of slippage is normal. You just have to expect that. With a limit order, there's no slippage, right, whatsoever, but there is the situation where it touches and touches and touches your price, and whether it's entering into the market or exiting the market, you're not filled, and that's really a problem, especially if you're right, you hit your target, you were prepared, everything was correct for what you were doing, but you didn't get filled. So that's really an issue that traders have to deal with. So I'm recommending MIT Market If Touched. I know NinjaTrader 8 offers Market If Touched, NinjaTrader 7 does not. As far as the information that I have, Market If Touched works with NinjaTrader 8. So for example, these orders here, if you place an order to go long or to go short, and you're number 225. So 224 contracts need to be filled first before you get filled at 225. So it's a ticket system. That's the way it works. It's an order ticket system that as soon as this touches your price, you're in line to get filled. A market if touched doesn't work that way. A market if touched immediately fills you. It says initiate the market order immediately. So that's why you have some slippage with that. And the same thing is true with stop orders. There's stops and stops with limits. For the newer traders, if you need help understanding stops or stops with limits, let me know. I'm happy to explain it. I think I have a video out there explaining MIT. If you go on daytrade2win.com, under the blog or the videos page, there's hundreds and hundreds of videos over the last 12 years that I've done, not just showing you trades and making money, but also trades on information on what works with the ATR, what works with managing your trades, the risk involved. Speaking of risk, a lot of traders ask me, you risk more typically than you try to make, and it's true. Usually my initial stop when I go into the market is a little bit larger than my initial target. It's absolutely true, without a doubt. Now, I say that because on paper, everyone says that doesn't make sense. But what really matters is that your entries are timed correctly, that you stay in the trade without getting out of the trade early, which a lot of traders get knocked out because their stops are too tight, and then use something else, some third or fourth measure to exit the trade if it's not in your favor. I absolutely think that you should have a catastrophic stop to protect you in case everything goes wrong. And at the same time, once the market gives you the initiation or the validation that it's not going in your favor, that you're at break even, or that you're in the minus, in the red, not in your favor, but yet it's been an hour, or it's been 40 minutes, or it's been half an hour. That should be your third indication to get out. So I'm not just using a stop as a hard stop to get me out and a profit target to get me out. I'm not just using the stop and the target. I'm also using time. If I'm in the trade for 20 minutes, 30 minutes, and this trade is still negative, I exit the trade. So that should be some type of time-based stop, some type of proof or evidence they should no longer be in the trade. So when you enter into the trade, think about an initial catastrophic stop to protect you in case the market goes straight against you and you're just totally wrong on the trade, and then use something else as time progresses to get out, or as proof or evidence. Let's say that there's another method or another indication that says you shouldn't be long. You should get out of this trade because now everything's turning short. So use proof, use time, and use some type of catastrophic stop in conjunction together to manage the trade. It's not just a profit and it's not just a stop. You have to combine all these things to manage the trade. Okay, so here's a crude oil short here as well. And I was looking here at the Atlas line here. This is the 5-minute chart on the Atlas line. The Atlas line is indicating 33.86 to go long. Let me just add the ATR. The average true range is something that I tell everybody, especially when using time-based charts, not so much range charts that you see here, but with a minute charts, so 5-minute, daily charts, 15-minute charts, 30-minute charts, always have this ATR, which indicates the amount of distance the market will move in your favor. So here would be 2 3/4 of a point or 2.5 points if you want to be a little bit more conservative. This would be the indication the market will move up or down this amount. So 2 3/4 of a point based off of the last 4 candles here. Off of the last 4 candles. So that's the distance the market could move. And based off of this value, now you can say targets, you can say stops, you can say I expect the market to go to this price as my initial target before I start trailing a stop. So this is very important. You can't have the same target and the same stop on every single trade that you take because it's dynamic. You have to adjust and conform to the current conditions. So that is very, very important. Or anyone have any questions? All right, let's talk about something else here with the trade scalper. I have a 5-minute chart with the trade scalper. Scalping is not typically 5 minutes. It's smaller. It's 1 minute. It's 30 seconds, let's say. It's a range chart. So if I change this here and I say I want to see a 10-second chart on the trade scalper, kind of change this up a little bit. Because I'm using price action to dictate all of these entries, the same thing is true. With a 10-second chart as opposed to a range chart or a minute chart, the entries are also going to be very fast, telling me to go long, long, short, long, short. This is pre-market here, by the way. And if I look here at the ATR, you can see that realistically, what I can expect out of the market using a 10-second chart is only about a tick. And so that is how you use the ATR when using a time-based level. When you look at now the market open here, this is increasing. This is 3 ticks. This is 1 tick. This is 2 ticks. So whatever trade you decide to take when using a time-based element, dictate it based on the current conditions. With a range chart, there's no linkage to time. So the reason why I'm suggesting 3 ticks and 4 ticks on a range chart, range to range chart here, on what you're seeing here, whether it be the crude oil or it be the E-mini S&P, is because it has no linkage. It doesn't use time to calculate anything. It just uses the price and the distance that the market is moving. No time. There's no time involved with a range chart. But with a 10-second chart, it's 10 seconds every candle, 10 seconds. So all these candles here, 10 seconds, 10 seconds, are making this line telling me what the distance the market is moving based off the last 4 candles. Just the last 4 candles. So we're really looking at the very last minute, 40 seconds to tell me what the market is doing. Okay. Okay. Short on the 10 second, short on the range chart, the crude oil is also short. Let me just get this out of the way here so you can see this a little bit better. Anyone have any questions? Oh, Jason, you emailed me. There's no chat box, Jason. Let me see if I can get that chat box working there for you. All right. So short on the E-mini S&P. Here's the 10-second chart, short as well. Remember, the goal is 3 to 4 ticks, 3 to 4 ticks. This would be here, right here, 3 to 4 ticks. That's 3 ticks, and that's 4 ticks. There. Just to kind of give you a perspective of the targets and what you're expecting here out of the trade right there, like that. Crude oil, that's good, that's good, that's good. The crude oil works really well with the trade scalper. So far, so good. Hopefully, everyone is getting a view of the trade scalper in action here. Okay, one last thing here that I'm going to review with you is what to expect as far as the number of trades that we could take. When I look at the trade scalper or the Atlas line or any type of trade methodology, the idea is not to take, let's say, all of these trades that you see here. The idea is not to take all of them. If you're short and you're trailing a stop here on the crude oil, then you should hold on to that and not add a position here. You should just trail a stop. There's another short, and then there's maybe another short or another short. You just hold on to that. If you're trading, let's say, 10 times throughout the day, and at the end of the day, you're break even, or at the end of the day, you're up a little bit or minus a little bit, I think that you should look at this in a different way. If you've made 2 or 3 points for the day already, I don't think there's a reason to continue trading, take a break, or look at a different market, or do something else, because really the goal here is not to just stare at this chart and just trade and trade and trade, because at some point you may have 2 losses in a row, as an example. And so if you have 2 losses in a row, you may give back, especially in the afternoon, the profit that you made in the morning. So try not to overdo it when it comes to the trading. I see the emails that come in where traders say, I want to trade 24 hours a day. I want to automate this. Really, that's not the way to go. You should take 4 trades, 5 trades, see where you're at. Are you up for the day? Are you break even? Are you down for the day? The time of day where most trades work out the best would be the first 2.5 hours, 2.5 to 3 hours. If you continue to trade into the afternoon or into that middle part of the day, I call that the B part of the day or the middle part of the day, typically the market slows down, you have more chop, and you can give it back. So I'm avoiding that situation of the market giving it back because you just want to continue trading. The last half hour of the day, usually the market accelerates. It gets faster as they squeeze the day traders who are on margin. They can't hold on to the trade overnight, so they get squeezed out. So expect an accelerated volatility as the market ends the day, last 15 minutes, half an hour. Definitely not something you want to be involved with. But the first 2.5 hours, 3 hours, take 5 trades, 4 trades, 6 trades, and call it a day. All right, you got it. Thanks, everybody. Okay, hopefully everyone enjoyed this video. The next mentorship class, which includes the Trade Scalper and the Atlas line and all the other programs that I offer, begin February 27th. That's the next class, February 27th. Email me if you have any questions. I'm happy to review with you to see if this is the right fit for you as a trader. So to do a quick recap here, this long trade right as the market opens is not, in my opinion, a good idea. let's wait a few minutes. Let's not get involved right as the market opens with a scalp trade. Long looks good. Short looks good. This short and this is oil down here. 1, 2, 3, 4. How many ticks is this? 7 ticks, right? I'm only looking for 4, 3 to 4. Same thing here, 14. And from here to here, 2.5, but just one. Just want one. Okay. All right. If anyone does have any questions, please email me at support@daytrade2win.com. And if you'd like to join the next mentorship class, February 27th, please let us know. Thank you, everyone. Take care now. Bye bye.